Hello, everyone. Thanks for joining our webinar today. Before we go over the agenda, I wanted to let everyone know that today will be the first webinar among a series of special edition webinars that will include a comprehensive overview of the One Big Beautiful Bill Act. We're going to offer further coverage on this during the upcoming Tuesday webinars and through the remainder of this month and into August. So in terms of the agenda, we're going to kick off the special edition with Frank Mayer from our Albany office. Frank will be discussing the top 10 tax takeaways as enacted in the One Big Beautiful Bill Act. And next, we will have Erin Callahan, who's also from our Albany office. And Erin is going to discuss some of the employment law implications of the act. And then after that, we're going to switch gears. And unrelated to the One Big Beautiful Bill Act, we're going to have Nick Jacobson and Colin Smith from our Rochester office discuss issues with respect to summer interns and minor employees. I will now turn the program over to Frank. Frank?
Thank you, Carrie, and welcome everyone for joining us today. On July 4th, 2025, President Trump signed into law legislation commonly referred to as the One Big Beautiful Bill Act. Now, we talked about the House version of this act in one of our recent presentations, but today we're going to talk about the law as enacted, which has a number of important changes from what we spoke about previously. So here we go. So the first thing is the extension of certain tax provisions enacted under the Tax Cuts and Jobs Act of 2017. As you may recall, that law had certain temporary tax provisions in it. Well, the new law makes many of the provisions of the Tax Cuts and Jobs Act permanent, including reduced individual income tax rates. For example, the expiring rate under the Tax Cuts and Jobs Act, the maximum rate was scheduled to increase from 37% to 39.6%, but the act retains the as a holdover the 30% marginal rate and makes similar freezes on tax rates that were scheduled to increase under the lower bracket amounts as well. So the law makes permanent reduced, as I said, individual tax rates. It increases the standard deductions and eliminates the personal exemption. It provides for a reduced ceiling and mortgage interest deduction and the termination of the miscellaneous itemized deductions. So it does add some certainty when preparing one's tax returns and planning on a go-forward basis. The second provision excuse me, is the increase in the state and local tax or SALT deduction, which you've probably heard about in the popular press. So the law increases the cap on individual deduction for state and local taxes that you pay. That would be your income taxes as well as property taxes for individuals from $10,000 to $40,000 for a joint filers for 2025. The cap is phased down till not less than $10,000 to the extent that modified adjusted gross income exceeds $500,000. Now, between January 1st, 26 and December 31st, 29, the cap and income thresholds described above will increase by 1% each year. So, for example, in 2026, the cap will be not 40,000, but 40,400, and that'll increase. Those will increase by 1% every year, including the phase-out threshold of 500,000. However, in 2030, this all resets to $10,000. So this is sort of a flash in the pan, if you will, but a welcome benefit for those in high tax states like New York, California, and certain others. You probably also read or heard about in the popular press talk about no taxes on qualified tips and overtime compensation. And of course, like anything else, the devil's in the details. Specifically, the law allows between January 1st, 2025 and December 31st, 28, an above the line deduction. In other words, a deduction for adjusted gross income for amounts received as qualified tips not to exceed $25,000 per individual and not to exceed $12,000 per individual for certain qualified overtime qualified under the Fair Labor Standards Act. Now, that said, the deduction is reduced on a scale by $100 for each $1,000 to the extent that a taxpayer's AGI, modified AGI exceeds 150,000 or 300,000 on a joint basis, joint tax return basis. And right now, the IRS and I imagine commercial payroll providers are scrambling to provide guidance to employers who have to be able to distinguish and report these items on a W-2 for 2025, because both the change for the qualified tips and qualified overtime is effective retroactive to January 1st of the year. So there are going to be a lot of people on the move to try to get this right so that people can report and pay the proper amount of tax due on these qualified tips and overtime compensation. Moving along, there's also a deduction for qualified automotive loan interest. And like qualified tips and qualified overtime, this is in place for the period January 1st, 25 through December 31st, 2028. It allows a deduction of up to $10,000 for interest paid on an automotive loan to purchase a new passenger vehicle, which includes SUVs, pickups, motorcycles, vehicles under 14,000 pounds. So not these big super duty commercial trucks, but more passenger vehicles. The requirement is that the purchase of the new vehicle must be a vehicle, the final assembly of which occurs in the United States. The reduction, like qualified tips and overtime, is reduced by certain thresholds. In this case, to the extent a taxpayer's gross income exceeds $200,000 for joint filers or $100,000 for a single filer. Moving forward, the law also provides something called Trump accounts. It creates tax favored accounts for U.S. citizen children born between 25 and January 1st, 25 and December 31st, 28, so retroactive to the first of the year. The Trump accounts will initially be funded with $1,000 of taxpayer dollars, and individuals can contribute up to $5,000 per year, which is indexed for inflation. And in addition, the law allows an employer to contribute to an employee's or an employee's dependents Trump account up to $2,500 a year. And finally, the law also allows contributions from certain tax exempt entities, such as private foundations, of up to $5,000, not subject to the $5,000 annual limit, provided that the recipients are unrelated to the contributor and it benefits a particular class of individuals. For example, all of the kids in a particular school district. So further, there's an extension and increase in the qualified business income deduction under the Tax Cuts and Jobs Act. There was a 20% deduction above the line for qualified business income. This was done originally under the Tax Cuts and Jobs Act to level the playing field for pass-through entities when the corporate tax rate on C corporations dropped from 35% to 21%. So the law also provides an increase in the phase-out threshold of $100,000 to $150,000, beginning at $394,600, adjusted for inflation. Annually, this will begin on January 1st, 2026. The Act also provides for bonus depreciation and increased business interest deduction to business-friendly provisions. The law permanently allows 100% bonus depreciation deduction on certain qualified business property, and it allows for tax years beginning after December 31st, 2024. Permanently increases the business interest deduction by calculating the amount of that interest deduction using EBITDA, or earnings before interest, taxes, depreciation, and amortization, versus earnings before interest and taxes under the existing state of the law. Moving forward, there's an increase in the federal, state, and gift tax exemption. The law, effective January 1st, 2026, increases the unified credit amount or applicable exclusion amount to $15 million for an individual estate indexed for inflation annually. That's up from $13,990,000 at the current federal unified credit rate. The act does terminate various Inflation Reduction Act tax credits. It basically repeals certain tax credits for electric vehicles, restricts or provides an early sunset of Inflation Reduction Act credits for clean electricity, fuel, hydrogen production, and hydrogen investment. So stepping back on green tax provisions. So the law also provides a tax on certain private college and university endowments based on student adjusted endowment. In other words, the endowment of the university or college divided by the number of students, and that's in 3 tiers, starting with 1.4%, which is currently the case under the Tax Cuts and Jobs Act, increasing to 4%, and then reaching as high as 8% in the highest bracket. And I think I've used about my 10 minutes up, but I'm going to throw one more at you. The Form 1099 miscellaneous threshold, $600 reporting requirement that we can all remember as far back as we can, increase from $600 to $2,000 adjusted for inflation beginning in 2027. So it'll make the reporting of those items a little bit less burdensome. And so I think that's all I have for now. I'll turn it back over to Carrie.
Thank you, Frank. We appreciate your takeaways. Next, we will have Aaron discuss the employment law implications of some of the tax changes that Frank just mentioned. Aaron?
Thanks, Carrie. As Carrie mentioned, I wanted to follow up on 2 of the deductions that Frank mentioned to discuss the impact on employers. Our Labor and Employment Practice Group is constantly looking at these things to determine what type of effect they will have on our employers, whether that be from an operational standpoint, an administrative standpoint, or an employee relations standpoint. And certainly the deductions for tips and overtime will have some impact on employers. So let's talk about the tip deductions. Frank outlined the parameters in terms of the amounts and the phase out limits of that deduction, but I wanted to highlight some key points, which is that the Act contemplates the deduction being taken both for employees and non-statutory employees who earn tips in the course of a trade or business. There are different limitations and restrictions for those independent contractors or self-employed individuals, but nevertheless, we need to keep in mind that that deduction is both for employees and non-employees. In terms of what the deduction can be taken for, we're talking about qualified tips earned. So what does that mean? It means voluntarily made payments by customers, cash, credit card tips, directly paid to an individual by a customer or through a tip sharing arrangement such as tip pooling. Automatic mandatory service charges aren't included in that definition of qualified tips earned. And so the clear example would be when you go to a restaurant with a party of 6 or more, that automatic charge of 20% isn't included in the definition of qualified tips earned for deduction purposes. The other thing that we need to keep in mind is that this deduction is for those that earn tips in a traditional and customarily tipped industry. I think we can all assume that would mean the hospitality industry, the beauty services industry, but the Treasury Department is going to be issuing a list of occupations sometime early October that confirms what occupations are eligible for this deduction. So in terms of direct impact on employers, our W-2s and 1099s going forward need to report tips and identify the worker's qualifying tip earning occupation for purposes of eligibility. As Frank mentioned, we're going to be on the lookout for both IRS guidance, third-party guidance, as to how to report that on W-2s and 1099s, particularly for this year, 2025. The third bullet on the screen, I'm mentioning it and is totally above my wheelhouse. But employers will want to work with their tax attorney and accountant to determine whether they can take a FICA tip credit. That tip credit was traditionally for those who provide, deliver, or serve food or drinks for consumption. The Act has expanded that tip credit for those in the beauty service industry. So moving on to the overtime deduction. From my perspective, this is the most interesting deduction in terms of various impact on employers. But to recap, it provides for a deduction on qualified overtime compensation, which is what's required to be paid in excess of an employee's regular rate under federal law. So as an example, if I make $15 an hour, my overtime rate is $22.50, and I work 1 hour of overtime. For that 1 hour of overtime, I can seek a deduction in the amount of $7.50, what is in excess of my regular rate under federal law. Qualified overtime compensation does not include heightened requirements under negotiated collective bargaining agreements or even state law requirements. So for example, the spread of shift hours here in New York, that additional hour of pay would not qualify for this deduction. So impact on employers. Again, like our tip credits, we need to make sure that our W-2s report qualified overtime. In my opinion, the most critical thing that employers can do right now is some housekeeping around their overtime policies and practices. There's more incentive now than ever for employees not only to be non-exempt, eligible for overtime, and to work that overtime. So employers may be wise to review their policies to confirm that there's some parameters as to when employees can work overtime. So for example, with advanced supervisory approval, and most importantly, review their employee classifications for overtime eligibility purposes. Employees may come to employers to question their classification as a result of this deduction, but the consequences of misclassifying an employee or changing an employee's classification go far beyond this temporary deduction. So employers will definitely want to work with counsel in reviewing classifications and certainly consulting with counsel prior to changing any classifications. And certainly anybody in our labor and employment practice group here at Bond would be happy to help you with that process. So Carrie, that's all I have for right now.
Great. Thanks so much, Erin. We appreciate all of those tips and insights. I will now turn things over to Nick and Colin, who again are going to be discussing summer interns and minor employees.
Yeah, so we just wanted to discuss a couple topics that might be relevant here during the summer, including summer interns and minor employees. Starting with summer interns, one of the most important considerations is analyzing whether either under the FLSA or the New York State minimum wage law, whether interns are going to be considered employees and therefore must be paid. So for-profit employers, we're going to go through a 7-factor test next. But for starting with public sector and nonprofit charitable organizations, if the intern doesn't have the expectation of compensation, it's generally permissible for them to be unpaid. So the FLSA has a primary beneficiary test. It considers who is the primary beneficiary of the intern-employer relationship. And it's fact dependent, depending on the unique circumstances of each case. So the courts will analyze 7 factors without one factor being determinative. The first factor is the extent to which the intern and the employer clearly understand that there's no expectation of compensation. Any promise of compensation, express or implied, suggests that the intern is an employee, and vice versa. The second is the extent to which the internship provides training that would be similar to that which would be given in an educational environment, including the clinical and other hands-on training provided by educational institutions. Third factor, the extent to which the internship is tied to the intern's formal education program by integrated coursework or the receipt of academic credit. Fourth, the extent to which the internship accommodates the intern's academic commitments by corresponding to the academic calendar. The fifth, the extent to which the internship's duration is limited to the period which the internship provides the intern with beneficial learning. The sixth, the extent to which the intern's work complements rather than displaces the work of paid employees while providing significant educational benefits to the intern. The seventh is the extent to which the intern and the employer understand the internship is conducted without entitlement to a paid job at the conclusion of the internship. So then in New York State, there's some factors that overlap, but it's actually a stricter test where they look at 11 different criteria, and all 11 criteria must be satisfied for an intern to be considered an intern, and therefore to not be subject to the Minimum Wage Act. So some of these, the first five overlap a little bit with the federal test. The first, the training, even though it includes actual operation of the employer's facilities, is similar to training provided in an educational program. Second, the training is for the benefit of the intern. Third, the intern does not displace regular employees and works under close supervision. Fourth, the activities of trainees or students do not provide an immediate advantage to the employer, and on occasion, operations may actually be impeded. Five, the trainees or students are not necessarily entitled to a job at the conclusion of the training period and are free to take jobs elsewhere in the same field. The sixth, the trainees or students are notified in writing that they will not receive any wages and are not considered employees for minimum wage purposes. The seventh, any clinical training is performed under the supervision and direction of people who are knowledgeable and experienced in the activity. Eight, the trainees or students do not receive employee benefits. Nine, training is general and qualifies trainees or students to work in any similar business. It's not designed specifically for a job with the employer that offers the program. 10, the screening process for the internship program is not the same as for employment and does not appear to be for that purpose. The screening only uses criteria relevant for admission to an independent educational program. 11, advertisements, postings, or solicitations for the program clearly discuss education or training rather than employment, although employers may indicate that qualified graduates may be considered for employment. So considering these two tests is an important thing to think about when bringing on an unpaid intern, because the implications could be that you end up subject to having to pay the interns if they're deemed employees. And New York State does have some exceptions for not-for-profits if they're categorized as volunteers, students, trainees, and learners. And but all three of these must be for an organization that's organized and operated exclusively for charitable, educational, or religious purposes. This is a nice chart. I'm going to pause for a second just so you can take it in, but it gives a breakdown of the New York State labor laws on the permitted hours of work, either the weekly hours and the specific times when minor employees can work depending on age. And this does vary depending on if school is in session or if it might be something like summer vacation. And some additional New York specific labor laws is employers must post the schedule of work hours for minors in the establishment. And also minors are required to obtain employment certificates, also known as working papers. And there are penalties. So for the first violation of these child labor provisions, maximum penalty of $1,000, second $2,000, and third and so on is a maximum of $3,000. In New York State also has specific occupations that are prohibited for minors that vary with age. So if you're under 16 years old, you can't perform factory work, dangerous farm jobs, painting or cleaning the exterior of a building or structure. And if you're under 18 years old, you can't work construction, mining, logging, or operating power-driven woodworking, metal forming, metal punching, metal shearing, bakery, and paper product machines. And these are just some of the examples provided under the New York regulations. For anyone under 17, they cannot drive. And if you're 17 years old, there's specific things that must be met. So it must be limited to daylight hours, have a license, take driver's ed that's approved in the state, can't drive a vehicle that's over 6,000 pounds. The vehicle must be equipped with a seatbelt for drivers and passengers, and they must be instructed. The seatbelt must be worn, and it can only take up a third of the employee's workday, or a fifth of the time in the work week. And something I found interesting too is that all minors are prohibited from making time-sensitive deliveries. So pizza delivery drivers, minors aren't allowed to work in those occupations. And actually a Virginia pizza business actually was recently fined over $17,000 for employing minors as pizza delivery drivers. And also, there's certain regulations having to do with working in food service. This mainly applies to 14 and 15-year-olds. The jobs they can work in food service industry: cashiering, busing, cleaning, helping with the preparation of the food. You can use like a milkshake blender, and they can cook on electric or gas grills, but not over an open flame. And they can only operate deep fryers if it has a device that automatically lowers and lifts the basket into the fryer. And once the employee turns 16 years old, the main regulation is that they cannot use certain power-driven meat processing machines or bakery machines that might be dangerous to them. Yeah, that's all we have for now. Nick, you have anything?
Yeah, I just echo what Colin said about the potential ramifications of misclassifying employees as interns. Not only would you potentially be liable for paying them the wages, but you could also be on the hook for liquidated damages. So for an individual that you thought could be unpaid, you could essentially be on the hook for paying them twice. So definitely something to keep in mind, especially given how strict New York is on classifications of employees versus interns.
Great. Thank you, Nick and Colin. We appreciate the refresher on all of this. And thank you everyone for tuning in to the webinar today. We have the contact information here for all of today's presenters. Please feel free to contact any of the presenters or myself if you have any questions. I will be hosting the webinar again next week on July 22nd. I hope that you all are able to join me. Have a great rest of your day.